Hey, what's up, stock compounders? Brad here. So today I'm going to show you how to easily find the intrinsic value of a stock. Big shout out to both Phil Town and Hamish Hodder to kind of help me piece this together for you guys today. So let's take a look at what this entails, how to calculate, how to determine the intrinsic value of a stock. So the method I'm using, we're using earnings per share from the last 12 months, okay? We need earnings per share. We need an earnings growth rate over the next 10 years to determine what the earnings per share is going to be in 10 years. And then we also need a future price to earnings ratio. That's going to allow us to convert that earnings per share in 10 years into a price per share. You have an earnings per share, you multiply it by price to earnings ratio, and you get price. So it's pretty simple, guys. It's hard to get simpler than this when it comes to calculating the intrinsic value of a stock. And yet, even though it's so simple, I think it's quite powerful. So that's a great place if you're just getting started, learning how to calculate the intrinsic value of a stock to determine, if it's a good price or not. So let's just go through these equations real quick. To calculate the future price, right, the price in 10 years of a share of this stock, we've got the earnings per share. We have to multiply that by 1 plus the growth rate. The growth rate is going to be a percentage. So in this case, it's almost 20%. So we're going to have 1.195, right, to the number of years that we're looking out. So in this case, we're looking out 10 years. So we're going to have 1.195 to the 10th power, okay? And then we need a future price to earnings ratio. When we multiply all of that together, that's going to give us the future price. And then we've got our fair value calculation. So for this, we're discounting back the future price 10 years using our discount rate. And the discount rate is going to be our required rate of return. This is something I got from Phil Town. He says, if you got to get at least a 15% return on something for it to be compelling, or for it to be worth taking the extra risk, where you can get 10% from the market really by doing nothing, right? You just buy an index fund and it's averaged 10% per year over the last number of decades. So if we're going to be picking individual stocks, we want to be compensated for doing that, and that's where this 15% comes in. It's a bit of a premium to what you'd get just from buying the market. So that's how you get the fair value, the price that the stock is worth today, the intrinsic value, so to speak. And then the buy price is really just going to be half of the fair value. We don't want to pay sticker price, right, for a stock. We don't want to pay fair value. We want to get a discount on that stock because these are estimates. The future price to earnings ratio, the growth estimate, you can see right there, it's an estimate. And so if we're buying at a discount to fair value, that means we can make mistakes in our estimates and still make money, right? Or, if the company, looking back 10 years doesn't perform as well over the next 10 years, that's possible as well. So we've built in a cushion if we're buying at a margin of safety. And that's what this is, MOS, margin of safety, 50%. We want a 50% discount from the fair value. So let's get into some numbers here. In order to find the earnings per share from the trailing 12 months, the last 12 months, we're going to jump into Morningstar. This is free. You don't need to have a membership to this. We're going to go to Morningstar. You're going to type the ticker up here, Facebook, and you're going to pop into the Financials tab. And what we're looking for is trailing 12 months earnings per share, okay? Diluted and normalized are the same. $8.18 earnings per share. So that's what we're going to plug in right here. 10 years, that's what we're using for this spreadsheet here. The stock price today, again, you can go into Morningstar, and we're going to go to quote, the first tab there. And we're going to see that once it loads, we're going to see the price of a share right here, $259.94. So 259.94, that's the price today. And then the only two other pieces of information we need to find here are the future price to earnings ratio and the growth rate, okay? So for future price to earnings ratio, one thing we can do is we can go to valuation tab in Morningstar. And we're looking for, the kind of price to earnings ratio history. What has the price to earnings ratio been for Facebook over the last number of years? You can see if we go back to 2012, 2013, it's very high. People were very excited about this company back then. It's come down a lot since then. Currently, it's around 32 price to earnings ratio. I really, as a rule of thumb, don't like to go higher than 25. You can see most of these are quite a bit higher than 25, but Facebook is really a growth company. It's in the growth phase of its kind of business life cycle. So in 10 years, I don't think it's going to be in a growth cycle anymore. It's in a growth phase. And so it's not going to have these price to earnings ratios that growth companies tend to have. They're going to be more conservative than this. It's going to be more like it's going to be a great company still, I think, in 10 years, but it's going to be a more mature company. And so for Facebook, because it's a great company, I'm going to assume the price to earnings ratio in the future is around 25. I don't like to go over 25. I think Facebook is going to be a great company in 10 years still. So I'm going to give it a price to earnings ratio of 25 in 10 years. And then for the growth estimate, what we're going to do here is we're going to look at what was the equity growth over the last 10 years, okay? So in order to do that, we're going to go back to financials. And we're going to look at, come on now, let's give me some data here. I know there's data available because we just looked at that. Anyway, that's annoying. So what we're going to do, maybe we can still do it. We're going to expand the balance sheet items. Okay. And we're going to come all the way down. We can see total equity here. Okay. Now, I looked this data up in Morningstar. And the way I ran that is I looked at it. There was 9 years worth of data in value line, okay? And the equity growth rate, the amount this changed here over those 9 years from 2010 to 2019, the growth rate was 32.4%. So, the equity growth rate is a really good indicator for how earnings per share is going to change over time. Because really equity is what we get as equity investors. That's kind of our piece of the pie. So we want to know how the equity is growing over time. So 32.4%. That was actually over 7 years. That was all the data that was available in value line, 7 years. So 32.4% per year. That is a very high growth rate. I'm not comfortable using that high of a growth rate. So what I did for Facebook is I looked at what was the last 3 years. The last 7 was very high at 32%. The last 3 years was 19.5%. So, I'm much more comfortable with that. It's 32.5%, that is early stage growth. That is high growth. Facebook isn't there right now. They're not at 32% growth rate. So we're going to use this 19.5% that I calculated over the last 3 years of equity growth. Another thing you want to look at is the common shares outstanding. Okay, with Facebook, over the time I was looking at it, there was some dilution, meaning over that 7 years, there were more shares outstanding at the end of that period than there was at the beginning. So if you want to be more accurate with your equity growth rate, you want to factor how the number of shares outstanding are changing. If there's dilution, that's gonna dig into the equity growth rate a little bit. It's gonna lower the equity growth rate because there's more pieces to the pie, essentially. So I factored that in to get that 32.4%. And you'll want to do the same. If a company is buying back its own shares, the number of shares outstanding are decreasing over time, right? They're going down, which is great for equity holders, assuming, this is a caveat, assuming the company is buying back its shares when the price of its shares are less than the value of its shares. So that's an important factor, but we don't have to worry about buybacks for Facebook or Google right now because there was a little bit of dilution. There weren't buybacks, at least not in aggregate over that period. So we're looking at the growth estimate, 19.5%. Okay, so we've got all of our numbers. You can see the numbers in green here are the inputs that I just looked up or calculated. So we got a future price in 10 years of 1,214, and discounting that back to today at 15%, which is our required rate of return, we get a fair value around $300 per share. Okay. Now the stock price today is around 260. So if we buy today, we've got like a 17% margin of safety, which for a company like Facebook, a very high quality company, that might be compelling enough to you to buy Facebook at 260. I'm a very greedy investor, so I really like to get stocks at a 50% discount, not a 17% discount like Facebook is today, but a 50% discount. So I would love to buy Facebook at $150 per share. And just out of curiosity, I looked back. Was Facebook ever trading in the last year below 150 at a greater than 50% discount to fair value? And it was trading at $146 per share back in March, which is only a little over 6 months ago. So that gives me hope that Facebook could come back down to a 50% margin of safety. But like I said, it's a great business. It could be worth buying today, depending on what your prospects are for it looking forward. You really need to come up with your own growth estimate and comfortable future price to earnings ratio. These aren't set in stone. Okay, you have to decide for yourself what you're comfortable with in terms of those two numbers. So that's Facebook. Currently trading at a slight discount, 17% to fair value, according to my estimates. And I just want to look at one more company here, Google. We're all familiar with Alphabet, Google. Just wanted to take a look at Google. So I did the same thing. I looked at the trailing 12 months earnings per share. I put the stock price today. Same thing, future price to earnings ratio, 25. It's a great business. I think it's still going to be a great business 10 years from now. So I think a 25 price to earnings ratio is reasonable for Google. Google has a kind of a 10-year equity growth rate of around 17%. Okay, that's also factoring in some dilution. So if there were the same number of shares outstanding 10 years ago as there were today, this equity growth rate would be a little bit higher. But the shares outstanding is a little higher today than it was looking back. So important to consider that. So I'm going to use that kind of 10-year equity growth rate of almost 17% for Google. We get a future price here, discount back at 15%, and we get a fair value for Google of $1,338.50 approximately. That gives a buy price with a 50% margin of safety of around $670. Now, Google in the last year hasn't gotten close to that 50% margin of safety. Google is one of the top holdings for institutional investors. Google's a great business. Everyone knows it's a great business. It's been around for longer than Facebook, so it's got more of a track record. And so I'd have a real hard time seeing Google ever trading at a 50% margin of safety. But it was trading at a 21% margin of safety just back in March. So, depending on your appetite for Google and what you think of its future price to earnings ratio prospects and what the growth rate is going to be over the next 10 years. Again, recently could have been a buy for you back in March, maybe even more recently than that. I think this is in line with what I'm seeing from other super investors, what I'm seeing from the Dean of Business Valuation, Aswath Damodaran. So, it's a bit overvalued right now, overpriced, $14.55 compared to $13.38. So I'm definitely going to wait for Google to come down a bit. I would actually really like to buy it here, back at its 52-week low of around $10.50. I would be happy to own Google at that price. So, I'm not a stickler on the 50% margin of safety. Companies like Google, companies like Facebook, great businesses. I think, because they're such great businesses, because they're so predictable moving forward, you can be a little lenient on that 50% margin of safety if that's how you want to roll with it. But just wanted to run through this with you guys, kind of a simple approach for finding the intrinsic value of a stock. I know there's a lot of questions about how to do that, and there's a lot of different methods for doing it. But I really like the simplicity of this method. The one caveat here, because it's so simple, there's so much riding on this one number, the growth rate estimate. So it's important to really take your time in, considering a lot of different factors when you're coming up with the growth estimate. Don't be willy-nilly with the growth rate, especially using this particular method. All right, guys, let me know what you think of Facebook and Google, if your estimates of fair value are somewhat in line with this, or if they're quite a bit different. I'd like to hear from you guys. I'm sure there's a lot of you following those two great businesses. All right, guys, I will see you in the next video. Take care.